Rick Santelli standing by at the CME in Chicago. Long way from Pac West, Rick, but the ripples are being felt all over the place this morning. But what are these numbers?
Yes, the banking butterfly effect is what we call it in Chicago. All right, we're looking for initial jobless claims to be around 245, but it jumped up to 264,000. 264,000. Interest rates are going to fall down on that. When was the last time we were that high on initial jobless claims? To find a higher time than that, it would be October 22nd week of 21. So a bit of a ways back. And it's actually continuing claims that are more well-behaved today, which is the opposite of lately, expecting 1.82 million. We have 1,813,000, so just a bit under that. And our last look was revised from 1,805,000, 1,801,000. So continuing claims have definitely now remaining over 1.8, but not by much, and they're not really clearing the hurdle higher. All right, here we go. PPI for April, headline number expected up 0.3 is up 0.2. And remember, all these numbers peaked in March of 22. High water mark there was 1.6. If we look at X food and energy, which is core, up 0.2 as expected. That peaked at 1.2. X food, energy, and trade expected up 0.3 is up 0.2, and that peaked at up 0.9. Now the year over year, and this is very interesting what moved the CPI yesterday. Year over year headline has been moving down consecutively for 10 months in a row. Will it be 11? It is 11 months in a row. 2.3, this is following 2.7, high water mark there, 11.7. X food and energy year over year. It's been down 13 consecutive months, even though there's been a couple of duplicates. So 13, did it make it 14? It did. From 3.4 down to 3.2. High water mark here was 9.7. And finally, year over year, X food, X energy, X trade, 3.4%. That is now down, up 14 months in a row. Down. See, I get so excited, Joe, that these inflation numbers are so central to strategies. It's down 14 months consecutively in a row. There were a couple of doubles, meaning April and May and August and September of last year all were equal amounts. And last month was revised from 3.6 to 3.7. So after all of that, basically lower on every metric with regard to inflation. That isn't a bad thing. We can argue about the speed. Interest rates, it's funny because they did move down a bit, but here we are still hovering right around the same. We were at 338, we're at 336, almost at 337, but that alone is down 7 basis points. And when pre-opening Dow futures, they've been hovering right around the same levels, even though they're down on the session. Joe, there's a lot of numbers there. What are your thoughts?
I think Disney's down a lot, so that almost accounts for the divergence in the Dow right there. There's Disney, Rick, as you can see, down about 5%. I think we're getting hit with numbers that became less meaningful once we had the Pac West, sort of what we've been highlighting since we saw it happen. And it's, across the board, rearing its ugly head again. I know you probably saw some of the stuff Stan Druckenmiller was saying yesterday, that, probably not going to be 08 and 09, but don't assume it's just a walk in the cake, which is a great mixed metaphor.
Oh, exactly. And, listen, there's a lot of economists, a lot of analysts, a lot of traders, a lot of my sources who don't really see a recession coming. I don't know that it should be the complete focus, but I do think that ignoring these long-term trends and to think we're going to get away with the sins that we've committed with regard to where interest rates have been manipulated, all the spending we've done, and not only domestically but globally, and have just a soft landing, it doesn't seem realistic. And the issue is, just like inflation coming down, many of the variables that are going to push us towards recession have been very slow-moving and slow to unravel. But just keep an eye on those claims. They're telling the story.